Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your daily technical analysis of foreign exchange markets. I'll start with the euro against the dollar. An indecisive spinning top on Friday. Yet another manifestation of the continuing intraday indecision, buffing and rebuffing we've seen since prices dropped down towards a combination of February and March lows from 2017 at 104.92, as well, and perhaps more importantly, by the crossover 2 weeks ago of the previously highlighted lower time, currently 103.88, of the original January to May 2021 bearish Andrews pitchfork, and the middle time, currently 102.98, of the steeper and more recent mid-February to end of March bearish Andrews pitchfork. It's worth remembering a few things here. These two pitchfork tines had initially helped in halting the decline, but they are still bearish tines, so it would not be unexpected to see a resumption of the move lower in due course. Additionally, they are now splayed away from each other so that their combined force, greater than each counted individually, is no longer there. Hence, they will only have their own individual forces now available. I am once again mindful that the upper tine, currently at 106.63 of the previously mentioned steeper mid-February to end of March bearish Andrews pitchfork, is now rapidly approaching from above, bolstered as it has been since mid-April by partnering with the declining short moving average, currently at 106.58. This upper tine is one to watch. So far today, another test down to the support starting at 104.92, but then halting there, just sitting on top of it and not pursuing the move lower. Cable, aka sterling against the US dollar. A second bearish black crow on Friday, though it was also a lower yet indecisive spinning top. This comes after the previous session's immediate countering bearish engulfing pattern. It's also a new low not seen since June 2020. We're now in a fairly free zone all the way down to the June 2020 low at 122.48. We're overhead now. We have the resistance from the previous congestion support between 124.78 to 125.09. Now this contains within it the interesting 38.2% Fibonacci of the March 2020 to June 2021 move at 124.89. Overall, the recent action has been a continuation of the move down from the recent late February to mid-April descending triangle pattern. The initial target X for this pattern in the 126.55 area had already been achieved last Thursday, or actually before then. Last Thursday, though, the market achieved the harder secondary target X1 in the 123.60 area. We now look to the possible target X2 right on the 120 even area. This is the potential target for the last 3 weeks being a possible bearish halfway hesitation. So far today, continuation down towards the June 2020 low at 122.48, and overall moving through this fairly clear zone towards the target X2 in the 120 even area. Euro sterling. Friday gave this market a second bullish white soldier, but more importantly, there's also a number of things. To start with, it was a big second consecutive close up and over the long moving average, currently 84.43. Next, it was a second consecutive huge close up and over the upper downtrend of the December 2021 to date lopsided diamond pattern, currently 84.48. It was also a second consecutive close up over the April 2021 low, 84.70, which had capped the market effectively earlier this year. Finally, it was a second consecutive close, huge move up, and close over the September 2021 to date downtrend, currently at 84.83. And that had served as the upper trend line for the extended diamond pattern seen earlier this year. The action since mid-April had also set up the conditions for a bullish halfway hesitation. On top of all that, we also have just about to have a possible golden cross in the offing, with the short medium moving average currently 83.72, about to cross up over the medium moving average currently 83.73. Finally, last week was a weekly key reversal up. No small feat on its own. Okay, so there's a lot to consider there, and I hope to make some sense of it now. So, for the lopsided diamond pattern with a primary target X in the 86.80 area, and a harder secondary target X1 in the 87.65 area. For the extended diamond pattern, we have a primary target X2 in the 87.15 area, and a harder secondary target X3 in the 88 even area. Finally, upside potential target for the bullish halfway rotation will be at target X4 in the 85.77 area. There's one final pattern, and it is a big one. I've spoken about now for countless days, weeks and months now. It is a very large falling wedge pattern, 84.85 to 80.97 at the moment, which was still in operation, but which had fallen into the shadow a little with the diamond patterns. This pattern has also been triggered, and it has the most ambitious target on the upside. Target X5 for this pattern is in the 88.65 area. That is a huge ask, but it seems to be the season to give huge asks right now. To cap all this off, we have already reached target X4 last week. So far today, we're a seeming continuation higher, though within last Friday's range as yet. Prices continue their approach to the highs of December last year at 8,600 as well as November 85.94. US dollar against Indian rupee. A really interesting pattern last Thursday led to where we are now. Prices then gapped open lower, below the rising short medium moving average, currently at 76.17, below the lower time, currently 76.42 of the January to April bullish Andrews pitchfork, and below the recent 50% Fibonacci line at 76.20. Prices then dropped further, only halting just ahead of the combination of support at 75.96, plus the recent 38.2% Fibonacci line at 75.98. However, the market then turned right around, making a bullish engulfing pattern and almost a key reversal up, as market recovered to close back up within the bullish Andrews pitchfork that had just previously broken the same day. These moves diminished the threat to the pitchfork. Then on Friday, we had an even stronger move higher with a bullish opening white Mariposa that closed just under the 2020 high at 77 even. This strong close from a very low start in only 2 sessions set the stage for the most significant feature of last week, a weekly key reversal up. Looking ahead, we now have the possibility that the whole of the 2022 action could be a bullish halfway hesitation, with potential target X in the 78.30 area. Ahead, we now have the middle time of the bullish Andrews pitchfork, currently at 77.88, and the upper trend line, currently 78.05 of the late August to date ascending expanding wedge pattern. So far today, prices have continued to move higher with what looks right now like a bullish opening long white Mariposa with a new all-time high again. US dollar against the Brazilian real. A second bullish white soldier on Friday and a suitable follow-on higher to the previous session's strong reactionary bullish opening white Mariposa. Below, we now have the combined support of the flatlining short medium moving average, currently at 489.90, and a 2021 low at 489.08. However, the move up was capped for a third time this week by the combination of the lesser Fibonacci lines at 505.73 and 507.39 and the 38.2% Fibonacci line of the June 2019 to May 2020 move at 510.87. Additionally, we have the sharply descending medium moving average currently at 514.23 that may further cap any further bullish ambitions. Interestingly, this move higher was also a second consecutive close back up over the important 50% Fibonacci line of the October 2019 to May 2020 move at 496.58. Overall, the market has moved further away from trying all the way down to target X in the 444.20 area. This is the potential target area for the 2022 bearish halfway hesitation, and it seemed that achieving something like 80% of the distance to the target may have been enough. I may well retire this target after today. US dollar against the Mexican peso. An immediate countering bearish harami on Friday after the previous session's reactionary bullish harami. The move up was again capped, unsurprisingly, by the flatlining short medium moving average overhead, currently at 20.30.41. We still have a further slew of resistances above, and in no particular order, they are the long moving average, currently 20.42.92, the medium moving average, currently 20.39.07, the neckline, currently 20.47 even, of the September 2021 to March 2022 head and shoulders top, then the interesting 61.8% Fibonacci line of the July 2017 to April 2020 move at 20.60.62, and finally the upper time, currently 20.57.90 of the November 2021 to March 2022 bearish Andrews pitchfork. Additionally, we also have targets X2 in the 2049.60 area and X3 in the 2066.05 area. These are not resistances, but primary and secondary targets for the late March to late April double bottom pattern. Target X2, the primary target, was achieved last week, but target X3 may be becoming slightly out of reach, actually, of all things. Meanwhile, below, we have the top of the previously mentioned double bottom formed from late March through April, starting at just below 2020 even and stretching down to the 1971.68 support, with both the declining middle time currently at 1983.85 and the odd July 2021 based broken trend line currently at 2004.60 in there as well. So far today, a slightly higher open and run up to the short medium moving average, where once again, unsurprisingly, the market has been halted, though I suspect this time only temporarily. We'll see. Thank you for listening. This short version broadcast gives you essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investors International Limited. And here comes the final bit.